And what I would say is I still think Apple is way overvalued. I still think a lot of those tech stocks are way overvalued. And what's going to be so interesting is that right now we're used to the market trading inverse to the dollar, right? When the dollar was zooming up, every time it would go higher, the stock market would be under pressure. Now what you're going to see is you're seeing this little interim part where the markets are enjoying this pullback in the US dollar, but there will be a tipping point where the US dollar starts to go lower and lower and lower, and it's going to start to freak out the markets. And the reason why it's going to be bad for stocks is that the dollar going lower is going to signal a start of a bad recession, and it's going to be a recession that looks to get worse and worse and worse.
It doesn't matter if the US economy goes into recession or not, the stock market for the foreseeable future is royally screwed. On the surface, the problems facing the market and the economy may seem the same. Both are trying to deal with excesses, but those excesses are wildly different. On the economy side, the US is experiencing a violent bout of inflation created by the pandemic. Pent-up demand collided with a lack of everything from workers to widgets. Like a swarm of locusts, inflation is eating up economic growth, pushing up prices and nullifying wage increases. But some of the pandemic-related conditions that got us here, like clogged supply chains, are normalizing. And there's a chance we can solve the dislocations of the past 2 years without barreling into a full-blown recession. Through November 21, the S&P 500 is already down 17.1%, including dividends in 2022. Even so, while the stock market has certainly underperformed this year, the S&P 500 pullback is nowhere near the index's 34% landslide in March 2020 or its 50% crash in the 2008 to 2009 Great Recession. That's the thing with investing in stocks, especially for the long haul. There are going to be periodic pullbacks and cyclical downturns, which are a perfectly normal part of a healthy market. Still, the 2022 market weakness up to this point has investors concerned that the next big move for the stock market could take stock prices even lower. Gareth Soloway, chief market strategist at themoneystocks.com, shared his thoughts on what he believes is going to happen to the economy soon. Before we listen to him, please don't forget to smash the like button and subscribe to the channel if you are yet to do so. Thanks for watching our videos.
That the dollar going lower is going to signal a start of a bad recession, and it's going to be a recession that looks to get worse and worse and worse. And in those periods, the dollar will go lower, and that will actually hurt stocks in that situation. And it'll hurt stocks because if you have a bad recession, well, guess what? Apple's selling less iPhones, right? You know, Microsoft's selling less this and that. So they're going to make less money and their multiples will have to come down overall. So just be prepared for this little flip going on where right now a weaker dollar is nice for the stock market because the Fed's involved. Once the Fed gets to neutral and then we still see the economy cratering, then the dollar will start to fall even with the stock market. The party is coming to an end. There's no doubt about it. I think that, again, during COVID, and you guys probably experienced it down in Australia as well, people had a lot of savings because they couldn't go do stuff. So it's almost like a kid in a candy store right now where you get out there, you're like, oh, I'm free finally. I can go buy stuff and travel and this. But then you're like, wait a minute. Now I finally ran my credit card debt to its maximum and I'm out of money. Now what do I do? And that's where you start to see, oh my goodness, now we start to see job losses. And look for this, we're getting a jobs number in early December coming up next week. Look for the US jobs number to start to get worse. And I think that's what you're going to see. You're going to see this pivot point where you're starting to see people lose jobs versus gain. And that's going to be the trigger for people, the consumer, to really pull back on their spending.
Do you think that people really understand that we're going to be hitting a real road bump here?
No, I don't think so. I really don't think that anyone in this new economy has that sense, because basically, if you look at the last 20 years, or at least since 2009, every little hiccup that we've seen, the Fed has come to the rescue, right? Yeah. So we're kind of like a child that is wearing a helmet and a body armor, and like we can fall down a hill, we can fall off a cliff, and we're fine. We're just like, oh, no big deal. Well, guess what? That security measure, that safety measure is being taken off because the Fed clearly cannot print like they were in the previous cycles now that we have inflation rising, right? So the average investor is just thinking like, okay, we're in a bear market, but by January or February of 2023, we'll be making new all-time highs, so no big deal. That's what they've experienced, right? That's the experience for the last 13 years, at least, if not the last 20. So you have this scenario where people don't think it's real. They don't think the Fed is really taking off the bumpers here. And it's going to be a shock when the Fed, every investor and even big money is going to say, okay, Fed, we're in a recession, please start your printing again. And they're going to say, we can't. Inflation's 4 or 5% still. We can't print. And that's going to be the reckoning day where people freak out. Yes, as soon as the market or investors in general realize that the Fed will not come to the rescue as soon as we tick into a recession, that is going to be a wake-up call for investors. There's no doubt about it. A lot of times what you'll find is when people are most panicked, that's when we're going to get the bounce. But you have to recognize that in bear markets, it's just a bounce, right? So I go long, I go short. I go long, I go short. When I go long, we make money on the move up, but then we're taking it off the table very, very quickly as well. So it's about kind of understanding the macro picture and then understanding human psychology. All of that is all combined into what markets and what stocks do. And by, it essentially helps us guide people through. There's no doubt about it. And I think the key is here, there are investments that you can look towards. Like, for instance, gold. You guys know I've loved gold all year long. I said it would be the best performing asset between the S&P and Bitcoin. It obviously was for 2022. I think it will be as well for 2023, although it's a little trickier with Bitcoin now, because as Bitcoin gets to a low, it's a little harder to think about, all right, if it bottoms out in June or May of 2023, where is it by December? So it's a little trickier, but I still would go with the safety of gold with the uncertainty in crypto right now. But I also think that there are other places to look. Like, China is actually lowering rates. They just lowered interest rates. It's very risky there, no doubt about it, but I think that that's an opportunity. Brazil looks interesting to me. Their chart is unbelievably coiled. It hasn't made a new all-time high for the Brazilian stock market in something like 13 or 14 years. So it's kind of what I expect for the US stock markets has happened in Brazil for the last 13 years, and it could be getting ready to break out.
Every few weeks and without any real evidence, Wall Street will try to convince you and itself that Powell is losing his nerve, that the bear market is ending. Ignore all that. Even if he slows the pace of the Fed's rate hikes, Powell will not stop hiking because the economy's health is on the line. Stocks can and will go to hell. In 2018, small hikes sent the stock market reeling because it was in a bubble. The only difference now is that the bubble is larger, and thanks to inflation, the hikes are steeper, meaning the calm down is even more brutal than it would have been before. It's no secret that the higher interest rates rise, the more expensive it is for companies to borrow money to invest in growth. Inflation has already forced the Federal Reserve to raise its target Fed funds rate to a range of 3.75% to 4% in early November. But Powell suggests the central bank still has work to do to get inflation firmly trending back in the right direction. Economists aren't ruling out even more interest rate hikes in early 2023, especially if inflation remains high. According to JPMorgan Chase & Co., the Federal Reserve will raise interest rates by 50 basis points in December 2022 and boost rates by another 25 basis points at each of the first two meetings in 2023. We urge all our viewers to prepare for tough times ahead because we strongly believe that 2023 will be a very tough year financially. We are interested to know your thought on Gareth Soloway interview in the comment section. Thanks for watching.